Let me get things kicked off. I'm excited for our very first Alternative Investments Quarterly, a meeting that we are going to be doing obviously every quarter. We're excited to share with us a wonderful partner. In fact, I'll say the first partner for the Advisor Network, Infinity Capital. And that means a ton to us, more than I can even explain to you for a number of reasons. The first and foremost is when we find a partnership, somebody who's willing to invest in you, the financial advisors of this network and community. They did this before we had any, and that means a ton because they knew what this community would end up being. We know what this community will end up being, and we look forward to a long and growing partnership filled with wonderful content and education on alternative investments. So for a good number of you, you might have these already in your practice. We don't know. For some of you, you're just learning about them. For others, you're looking for unique and great ideas. And no matter what the flavor is of how you use alternatives today, we're excited to give you some opportunity to learn more and potentially use something in your practice that could be great for your clients. So before we get kicked off, a few housekeeping items that we wanted to share. In the chat on your Zoom, there is a link to Slido. This is an app we used from another conference. It gives you the ability to post questions for me as moderator to ask of Ben, who will be our guest speaker, or anybody from the Infinity Capital team, which I'll introduce Chris in just a moment to kick things off. So you can go on the Slido and ask your questions if you're another attendee and you want to like or opine on those questions. Keep the questions coming. If we do have enough time at the end, I'll make sure I ask those questions, and hopefully we have the time to get an answer or two from Ben before we hit our end. The other thing I want to make sure is very, very clear to everybody here is this is a collaborative experience. The question we asked on Slido is, would you prefer to attend things live or watch the recordings, or maybe it depends a little bit depending on the content. At the Advisor Network, the idea of collaboration is we want as many opinions as possible. We want you to share your thoughts. If you have a question, there's somebody else that probably has the same question. So please feel free to ask away. If Ben or Chris or Philip or anybody from the team at Infinity can't answer it, we'll certainly try to get you answers afterwards. So please ask as many questions as you can. But like I said, I'd like to start today by just a huge thank you to the team at Infinity Capital. They are a massive partner of ours. Thank you for putting your trust in us. And as we grow this network, we look forward to a long-lasting partnership. So without further ado, I'd like to bring on Chris Mahalko from Infinity Capital. And Chris is going to introduce himself and introduce the speaker.
Yeah, well, thanks, Colin, and thanks everyone here for joining. Colin's been a friend of the firm for a while, and when we got to know what he was building here with the Advisor Network, we were super excited about it. It's obviously a great idea, and we're proud to be partners here. Yeah, I'm Chris Mahalka. It's nice to connect with everyone here. I'm the Vice President of Business Development here at Infinity. We're an alternative investment manager. We've been around since 2002 and kind of allocated across the spectrum of privates. We tend to, like opportunities that are uncorrelated. And really as it sits today, have four kind of distinct business verticals. We manage roughly 1.5 billion in assets. I guess first kind of vertical is our legacy business. It's an off-the-shelf fund of hedge funds, where we're allocated with, top tier, what we would consider best in breed and large multi-strat hedge funds. So it's names you're probably familiar with. We also have a fairly robust custom portfolio business via master feeder structure. Have participated in a number of interesting ideas there as well, and also have direct access vehicles into other hedge funds that we know really quite well. We manage two internal strategies in-house, one of which is the gentleman to, I guess, the left for me. I don't know where he is on your screen. Ben Easterlin, he's the CIO and portfolio manager of Infinity Commercial Lending. So we'll get to that. I guess the other thing I would say is we also manage an affordable housing equity strategy as well. So there's a number of things we're super excited about. Private credit is certainly one of them. And I'll definitely kick it over to Ben Easterlin to kind of talk to that. Just a little bit about Ben. I mean, he's got 25 years in the commercial real estate world. Our team also has a pretty tremendous and interesting background. And Ben's prior firm is Angel Oak Capital, which is a firm you guys may be familiar with, but they're also local in Atlanta where we are as well. So, yeah, Ben, I think maybe it makes sense to kind of kick it off, talk a little bit more about your background, different opportunities we're seeing in the lending space. And yeah, we're here to answer any other questions.
Yeah, thanks, Chris. Welcome everyone. I'm Ben Easterlin, as Chris mentioned. I am managing director of the private credit group here at Infinity Capital. I came over here last year from another large asset manager um, with my team, primarily to focus on the RIA group as opposed and bring the institutional quality investors to pair alongside the private credit strategy we've been running for many years. My team is primarily everybody in it's got 25 plus experience. We cover the entire country, and we're focused right now only on the commercial real estate space. Other credit verticals be added in the future, but right now, it's obviously the one that's nearest dearest to our heart. The I want to point out that this was a strategy that has been around for a long time, and now we're just providing it as an opportunity to go into RIAs and get that same institutional asset quality. It is an income oriented approach. We basically focus on commercial real estate debt. It is senior loan portfolio of multifamily, retail, self-storage, industrial properties that we focus on for really robust adjusted returns, risk-adjusted returns. We are focused, again, like I said, on senior secured, but we also do mezz and pref equity. And just primarily, though, it's been senior secured this first year. We have a lot of clients in the insurance SMA space that we originate into and manage their portfolios. Again, it's just CM1 type loans. If you're familiar with insurance companies, they are income producing properties that it's not construction, it's not ground, it's not land, or it's not heavy lease up. These are all income focused properties. Our team, again, has been around for 25 years. We have distribution on origination on the West Coast and on the East Coast. I have New York and Newport Beach. We have underwriting, internal risk, treasury, and compliance all here in Atlanta is where we're focused. Our strategy, again, is just the senior secured loans. The theory is that, and I'm going to bring up a slide here and share it with everybody. It's based on the theme that there's a lot of opportunity in this space. It is right now. You've heard this probably from a lot of other managers. That there's a large maturity wall coming up in this commercial real estate space. We agree with that theory. I'll go through these three strategies first, then we'll come back and address each one. There's a loss of lending sources and declining valuations in the space. As I mentioned, with the large wall of maturity coming up, we are currently seeing somewhere around 500, 600 million annually. This we expect to mature this year, next year, a little over 3 trillion between now and 2029. Those numbers vary depending upon who you ask. Obviously, there's some not 100% surety of everything that's out there, but you can expect that most of the concentration of the loans is coming from regional and community bank spaces. These banks are heavily regulated. They've been forced in the last 2 or 3 years to reduce their exposure to CRE and try to maintain higher capital balances. Therefore, they are not making as many commercial real estate loans and hoping to get them off their balance sheet as fast as possible. We have seen that take place. I think our lending platform right now has more than doubled or tripled in size in the last year. And we're experiencing better quality loans that would traditionally go to these banks. Matter of fact, the banks are actually recommending they come to us. What they would like to see is they would like to keep their deposits, but they'd like to keep their clients happy. So they send them over to us. We're closing loans for them. They keep the deposits. Since we're a non-banking institute, we don't actually have to have deposits on account. In addition to that, I mentioned declining valuations. That's obviously been a real big problem in the last 2 years. Even in the multifamily space, we've seen slowing rent. We've seen slowing rent, and then reducing the overall income strategies, and then market pressures on everything from your operating expenses, utilities, taxes, and the cost of financing. Um, right now, if you were to look at the cost of financing alone, you're probably 150 to 200 basis points wider in your WAC, your weighted average coupon on a loan, than what you would be up to 2 years ago. So a lot of spread in there. There's a lot of opportunity for us to make loans on newly valued properties that would have traditionally gone into the banking space. And that has really just provided great opportunities for us to put it into structures, whether it's funds that Chris might have mentioned, private fund strategies that Chris might have mentioned here at Infinity, or into vehicles that include securitization. So we are actively either holding to maturity or putting loans into securitization as we speak. A lot of people ask, where do we source our product from? It comes from traditional resources. We get them again from banks and credit unions and debt funds that refer us that can't do certain properties. A lot of debt funds you might encounter today might have different mandates or strategies. You hear a lot of people say, I get a 15, 20% return. Well, I mean, yeah, they might, but those are also going to include properties that won't fit our mandate. Again, our mandate is that cash flowing asset that is lower risk and provides us the ability to produce monthly or quarterly returns to our investors. We also have references we typically get from legal and accounting. These could be the accounting groups are typically guys that have closed real estate transactions for many years, have dealt with us as well. Same thing from the legal side. There are not as many real estate closing attorneys as it may seem in this space, but again, they all do have preferences. We are easy to work with and have been traditionally used by some of the larger real estate firms in the country that and we get a lot of references from that. Same bars come back to us. I've been doing this 30 plus years, and so bars continue to return and ask for new loans. We do have limitations and concentration limitations on certain things, but reality is that as properties refinance or new acquisitions are made, that we do get a lot of repeat customers. My team again is across the country, so we're seeing a lot of borrowers come back once they have picked up a large portfolio and need a loan. And then we have commercial brokers. Commercial brokers are obviously the JLLs, the Cushman Wakefield's and such that, and then the smaller groups, the Gantrys and even Berkadias of the world come to us and bring us deals that they have. Most of those guys do not have funds. They're all broken them out, and that is where we come into play. Um, we do have a very rigorous underwriting platform. Presently, we don't have any delinquent or defaulted loans over the last 2 years, and we primarily pride ourselves on that. Again, just because they're cash flowing loans, we really spend a lot of time on the front end screening these loans. We have a process, and we have institutional partners that overlook our shoulder, and we maintain a certain levels of underwriting standards that we don't bend from. With the desire to put them into a securitization, that really creates a small box for us. We know what that box is. We have gone through the rating process, and in some cases, we even get a pre-rating and pre-place the bonds before we even make the loans on a managed type deal. Head of transaction management here is Dolly Laubach. She ran Cantor Fitzgerald's REIT program for 20 years. She has also closed. She also can manage up to 30 or 40 loans at one time. So the underwriting team, and we also do shadow underwriting with outside third-party resources. Again, we go through a closing. We have closing committee and credit committees that are make sure that all of the loans from the beginning of the end, from the term sheet through the closing, ultimately meet what we basically our mandate of our program is. It includes potentially, if we've got a warehouse lender, it may whatever loan covenants we've got that might be coming up, and then we also asset manage. And by asset manage, I mean we actually continue to talk with our borrowers over time. We meet with them. We get monthly reports from them, and we draft quarterly updates. We re-underwrite every property on a quarterly basis and put out a report that shows that the borrower is actually meeting his obligations. So I know from day one whether what the proposed plan was that the borrower put in front of us is actually meeting their goals. And then once we have that report, we're able to sit down and talk with that borrower to determine if they're on that right path. If they're not, that's how we get ahead of it. That's how we do. What do we need to do to talk to you about you're not meeting your leasing requirements? You have gone out and spent something on your reserves, new air conditioners that wasn't approved and didn't come back to us. We'll sit with them and talk to them about how they can be better borrowers as well. So, and then we have an annual review at the end of the year. These reports are all available to our investors as well. We presently provide them to every single client we have. That way we know each loan is meeting its goals. Some of the relationships we typically work with, I mentioned some of these guys, Berkadia, for instance, but we also buy and sell loans from groups. In the past, we have warehouse finance, we have securitized, and this is just a sampling of a group of people we typically work with. We have people always ask, what loans do you make? So here's an example. So we are making senior secured loans that go into securitization that are $5 to $50 million. They are first lien. Targeted returns on each loan are between 6 and 9%, and they are up to 5 years and 5-year term. Typically, all of these loans are no more than 60 to 65% LTV. I think our last portfolio was 61% LTV, and we feel like that's a good range to be in. It gives us 40% of equity coverage on a property, 40% equity coverage on a property. And don't forget, we are doing primarily refinances or acquisitions today. So these are on the new valuations that are being given today, which are about 30 to 40% below what they were just a year or two ago. So we feel like we got good amount of equity coverage in this range. We do some mezz and pref. Those are 15 to 18%. That's far and few between. Those are 36-month loans, and we typically only go 5 to 10% over. And then we have some note purchases as well that are just really opportunistic. We partnered with some larger institutional partnership groups that have looked at portfolios. Example would be a Wells Fargo portfolio of multifamily loans that are about $10 million and have call it a 6% coupon from a bank that they purchased in Southern California. They need to reduce their size and exposure of that, so they might sell it at 85, 90 cents on the dollar, and that gives our coupon the juice it needs to sort of get in the range where it might be a senior secured loan in the range of the target return we're looking for. So, again, that's on an opportunistic basis. Don't see that very often. The primary focus on what we do is the senior secured note. Just as an example of one of these properties, this is a loan we made about 2 months ago. This is a great example of what we're seeing in the market right now. First Republic Bank in New York City shut down. Again, the loans were all sold to Rialto. Rialto's position is that they are going to hold the loans and look for equity returns on properties that might go into distress. And then they will sell the performing loans out to banks or other parties, ultimately because they're looking for higher yielding returns. In this case, this loan matured prior to them selling a portfolio to another bank, and we ended up with a potential borrower that had owned the building for 40 years. It was in New York City. It's 55 units with a vineyard, 6,000 square foot vineyard vines on the Upper East Side of New York. The partner had a $20 million loan on the property, and he had to come to the table and refinance and bring close to $5 million to put into this deal. So we've refinanced on a lower valuation, 60% on our newly underwritten LTV. We got a 6.9 fixed rate coupon for 60 months. This guy, the borrower, is a great borrower. He has no intent of ever selling this building. He's primarily kept it leased up even pretty much through COVID. And I'll tell you that what we expect that loan to do is we expect that loan to refinance into an agency mortgage at some point when the interest rates are lower. A lot of our borrowers are playing the interest rate game. They think the interest rates are going down, and so they don't want to enter into a 5 or 10 year conduit or conduit loan, or a long-term 10-year agency mortgage at a 7% coupon. They would much rather wait until the rates are at 5%. So this guy's grinding it out for 5 years. We do have prepayment penalties in here, so if he does pay us off early, we should get the effective full yield on this property as if we hadn't been paid off. But the borrower is willing to do that because he's playing the rate game and hoping the valuation will continue to rise as rates come down and cap rates come down. I'll give you one more example of another fixed rate deal we have. This is a developer that had a broken property deal. He provided a mezz loan in Dallas, Texas, for a group that was going to uh, build a property. Well, they built it. Then they couldn't pay him off. So we gave him a 3-year fixed rate loan at 8.75 at 60% LTV. That was an excellent. He leased it up. He's gonna get some history behind it, and he's playing the rate game too, and he's gonna finance us out. That's another place we could find some area where we could grab some extra yield, just by the developer needing a little lease up flexibility. We felt like he could do it, so we came to a quick 30-day close, I believe, and off to the races on that one. Floating rate deal. This is a garden style apartment that was built in Pinehurst, North Carolina. We made it 60% occupied. The developer was a very experienced developer. We expected him to refinance us out, which he did within a year. Obviously, we made this during 2022. Rates were a little lower, and it obviously got paid off. If today's rate, that would be like 8.88 coupon. At the time when we made it, I think it was a 5 coupon. He paid us off, got him a fixed rate loan. But again, for him, it was $60 million with a future funding of 6, which he never met because he refinanced us out for. He never earned that money. So we only made a $54 million loan at the end of the day. But he ended up refinancing us out. So that's just an example of 3 of the type of loans we're typically putting into these properties. Some of my team, I think I've mentioned before. I mentioned before Dan's head of East Coast originations. David's out in Newport, and Dolly's here in Atlanta running all the transaction management. I do believe that this team is far superior than what you get in most places. And we've been through multiple cycles where we understand, the importance of the front end underwriting to get to the back end asset management just to produce the cash flow returns we are promising or not promising, that we're talking about within our funds. And I think that goes a long way. But ultimately, we take the approach of we do not want to own a property. Not that we can't. As Chris mentioned, we do have an asset management group here that develops and builds low-income housing and housing itself, multifamily. And each of my team members has been through a cycle or 2 or 3 even. But the reality is we want these developers to be successful. We want the goal here is a fixed income product that ultimately you can go to the mailbox and get your check every month and or quarterly, month or quarterly, depending upon the funds you're in, and we can not have to worry about it. You want us to know on our back end that we're underwriting and managing these properties appropriately. And I think we do a good job like that. From a general market standpoint, we are seeing good opportunities in the multifamily space, lending space, and it is about 70% of our production these days. We are originating retail and self-storage and student housing. We've done some multifamily last year. I'm sorry, mobile homes last year. Those are not the mobile homes you may see with the dirt road and somebody put it up in the middle of a field. These are with professional mobile home parks with amenities, including roads and curb and gutter and pools and on-site management in 99% of the cases. So um, we have avoided being in flood zones and fire-prone areas like Malibu today. But we are still seeing mobile home parks, and they are a good cash flowing entity, very similar to self-storage in a lot of way. Um, we've also been making some loans and build to rent. So there are a lot of single family rental companies that Pulte, Horton, you name them, some of the larger publicly traded groups that now are not just building single family homes to sell, they are building them to rent. We are taking those construction loans out with 5-year fixed rate loans in most cases with these properties. That has been a great product, especially on an infield in places like Greenville or Birmingham or Jacksonville. And um, they're just an alternative to multifamily. And we are finding that in certain places of the country, that is becoming a lot more popular than multifamilies. Somebody might not want to walk up and down stairs. They might want a garage so they can put their boat in it. They may be in the military and they want their family to have a yard to play in the backyard or something. We see a lot in Fort Benning area, Columbus. And these are all coming from very large, sophisticated developers now that used to build just multifamily. So we think the product's a good product. We've been able to underwrite it, manage it appropriately. Um, One thing I didn't mention is office. The office is what everybody wants to talk about these days, and we have made some office loans this year into our insurance accounts. They are very specific properties, 100% leased by a single credit tenant with a 15-year lease on a 5-year loan. In certain cases, we find that to be invaluable, and we're getting 9, 10, 11, 12 coupons on that on a senior secured note at 50% LTV. So in that case, we have made them. We don't frequently make them. It is deal specific, primarily because there is so much noise around office in this market that we don't want to have to talk about it every day unless it is a good product in case something were to go bad. I don't want somebody to ask me, why'd you do that, Len? We all knew the office market's bad. Well, the office market's not technically bad. 1% of all the properties in the office properties in the country create 30% of all the vacancy. So there is a lot of good office property out there, and it is definitely location and deal specific. And again, who knows where the market's going? And right now, it is a good yielding property. Hotels, we do limited service hotels very rarely. We have been making them for 20 years. There are specific lenders out there that sometimes we feel might be better opportunities for them. RevPARs are still relatively high, are moving up right now, back from their pre-COVID, back up to pre-COVID levels. We think that that will continue through 2025. I can't really predict 2026 or later, but expectations are on, again, coastal properties, properties that are Hilton Garden Inn next to some kind of economic driver like a hospital or a college or something also could be an airport could also be good as long as it's been well maintained. Um, I think that overall, we are starting to see a few more participants in this space, but the CMBS market is still picking up only the largest properties in the country right now. Really, as there's been a heavy focus on SASB, single asset, single borrower CMBS deals this year. CMBS was down 75% issuance last year. It has come back this year, but it is heavily dominated by that larger product. And we are seeing a lot of former securitized lenders, groups that securitize product, bring stuff that they had on their books that is, 2 years seasoned into a securitization, and they're mixing multifamily with a couple of office deals or something that may not be opportunistic if they had done it an office portfolio or they're mixing, they're barbelling this thing with some good properties and bad properties. So again, we're truly focused on new origination right now. So it is a vertical at Infinity that they didn't previously have. I think in the last year we have brought good value proposition to the investors here. We believe we can expand this into a multi-billion-dollar platform this year, and are hoping that that there's some focus as these continued regional and community banks continue to struggle to make loans, and we continue to see good product coming to us. So, um, and that's where we feel like we are. I'm I'm happy to answer any questions or talk more about anything specifically you talk about. But again, we are focused on income producing properties, and I'm happy to talk about the market and construction and where we're seeing other opportunities. But right now, Infinity is focused on this particular product.
Yeah, and then what I want to do is maybe share the questions that were already posted.
Okay.
And then what I want to do, Chris, is maybe come back to you afterwards. You can give a little bit of information how folks can learn more about how to actually implement this, right? How to reach out to you. I'll make sure that's clear by the end, that that's the best way to do this if folks are interested in learning more.
Sounds great.
So, Ben, you answered part of this already, but I'm going to change the question because
Okay.
this came in at, about maybe 15 minutes ago. So you answered a little bit of this just a couple of minutes ago, but the question specifically from Slido, and please, everyone ask questions. I think we have time for at least a couple. So there's two on the screen right now. They asked, are you worried about the post-COVID work from home movement for your potential borrowers? And I think that specifically is office, right? And you kind of just identified a few minutes ago that specific situations are accessible, and maybe a few bad apples tend to ruin the bunch for the overall market. Let me change the question because I think you answered it on office fairly well so far. What other areas are you worried about? What are you staying away from? I know what you kind of said that your sweet spots are, but what other things are you kind of more worried about if it's not just office?
That's a good question. Let me answer the question about work from home first. I will tell you that there is uh, a, a palpable im impact on office occupancy related to work from home. Work from home is not going away. My wife works from home, and not just to stay at home. She works for an insurance company, and they eliminated 100% of their office space in the Atlanta market. Um, uh, that did not make her happy about that, but the reality is that was the mandate from the corporation, and we expect more companies to continue to right size their properties. Law firms, I saw a statistic here in Atlanta this week that law firms, there must be 5 or 6 law firms out right now looking for new leases, and they range from anywhere from 100,000 square feet to 250,000 square feet, which are the larger law firms. Now, those law firms, when they entered their last 5 or 10 year lease so many years ago, they were at 150 and 500,000 square feet. So there is a reduction, not only a work from home, but there's a reduction in size of properties and the use of properties. Lawyers are not having law libraries. They allow people to work from home, and they are downsizing office sizes to make them all consistent. We expect to continue to see struggles in the market, especially when in properties. How do I say this? In the suburbs. The suburbs where there were a lot of single story or 3 story office buildings that were about that leased up during COVID or completely vacated during COVID. Either one, those are having problems. People paid money for those because they thought, hey, these guys are going to move out to the suburbs and maybe go to an office once a day or something like that. That's not happening. We don't expect that to ever happen. The building I'm standing in is one of the largest buildings in Atlanta. It is a fully engaged building run by a publicly traded REIT named Cousins here in town. They've got another one right next to me, and both of them are 100% leased. These parking lots and the people in this building are here all day. That's exactly the point, Colin. We expect that these specific, totally activated communities buildings will, they've got restaurants, they've got dry cleaning, they've got bars or whatever it may be, and bowling alleys now. In New York, I know of one that they put in a pickleball court. So people are coming in. They have daycare centers. But the smaller ones, you come back to me in 10 years, and I'll tell you today is $30 a square foot in rent. 30 years from now, 10 years from now, it'll be $30 a square foot in rent. It's just there's no appreciable value in a lot of them. So yes, we are definitely staying away from those. Um, Other properties that we've had some concerns about, I think I kind of mentioned hotels. The RevPAR is picking up. A lot of people did not spend the money to update their properties during COVID. They're getting crushed from behind right now. We think that those properties will continue to lag. There are new concepts that are coming out that are replacing them. Um, but right now, it seems to be that work travel's come back a little bit. We're just very cautious on that. It just seems to be, if you travel, you know how expensive it is to go to a hotel now. And pre-COVID, it was $120 to stay at a Holiday Inn, and now it's $300. So in Atlanta, so that's a lot of it cost, and it remains to be seen on whether or not they can maintain those RevPARs. But again, we're focused on limited service, so we are only focused on the income streams, not on any additional income coming from weddings or conventions in space. Matter of fact, if you go to Miami right now, the convention business is booming. So great for those guys. Again, it's just hard for us to focus on product like that. Self-storage, we have seen a lot of good self-storage this year. We've also seen a lot of bad self-storage this year. A lot has been built in areas you could not build or would not build a multifamily building, but they use multifamily valuations for land. So we think there's some properties out there that have higher valuations in the self-storage space. Um, than they probably need to be. And there's been a big push from some big companies to label their put their name on the product that is just not sufficient for what they really should in order to continue to show expansion. And we're turning some of those down.
Let me one more for that because I have
Yep.
another question here. I want to encourage if there's another one afterwards. We got Ben for a moment. Please ask if you want to now. The next one's a kind of an interesting one because you use this word. But what about student housing? For a while, there was such a pop, right? And
Yep.
then, then COVID happened, right? Back to the COVID change of a lot of things. I didn't hear you say that in pro or con.
We like it. It's housing for us. I understand it's annual lease up, so every year you got to lease the entire building. You have to understand what you're underwriting. Let me say this. You will see student housing continue to grow. There is a massive shift at colleges away from owning the building and maintaining it to ground leasing the properties to a landmark properties who might be one of the largest student housing groups in the country, based out of Athens. But there is we expect they'll continue to push. Colleges are continuing to push people to live in dorms. It is a new income stream for them having a ground lease. Part of the ground lease might require that you cannot allow your kids not to live on campus for the first year, kind of thing. Um, I know there was a new 600 unit development going in Atlanta right now across the street from Georgia Tech. It's current student housing. So, it's a good product. Again, it depends on if it's rented. A lot of it's rented by the bed and as opposed to just the room. So there's some uniqueness on how you have to underwrite it, what your cash flow streams, how your manager and operations needs to be an experienced group that understands that cash flow is not going to be year round, or at least fully leased year round, and how they manage that cost. And then we're seeing, I'm from Americus, Georgia. Don't it's a great little town in South Georgia. We have Georgia Southwestern there, and that somebody's trying to build one there. That will not be successful, and it will always be the same B-level property that it always is being built for, and whether or not it's full or not, because you're not going to be able to make somebody in Americus, Georgia, go live in a dorm. We've seen them in some of the middle-sized schools. Spotsylvania University, some of these other groups that are okay, but like if it's University of Georgia or Michigan, all in, right? We also have a very strict item as well. It has to be within 1 mile of the center of campus. Anything that's outside of that 1 mile of center of campus, in our minds, is not student housing. It's apartments that have students in it. And we do not believe that that is the same thing. If you are too far for a child to walk or willing to walk to school, then to us, it's not student housing.
I would agree with that. In Buffalo here in the winter, you
Yeah,
better be within a mile.
right,
Yeah,
right.
it's a long way to go. Thank you for that clarification. I appreciate you sort of letting me twist the question a little bit, which
Yeah,
was a
sure.
good one. And the second one that we got so far, last chance if anybody wants to add it. I'm going to ask this one to Ben, and I'll check the queue again here. Which I love this Slido, by the way. This is very cool. Um, you said the word distressed before, but the question that came in is your product distressed debt?
No,
Is it, or would
we,
you call it I heard opportunistic, but you said
yeah,
distressed once or twice in there. Just maybe opine.
yeah. Let me expand on that. We are not distressed debt. 100% not distressed. We are looking for income producing properties that have experienced operators and developers and borrowers that have large portfolios. We are not looking for someone new that may be in the business or somebody. Um, we have not. We are not buying distressed debt. We do not want to own the property, and um, therefore, we are looking for properties that once we underwrite 60% LTV, that there's at least a 125 debt service coverage ratio. And we know that that property at the new underwritten value can be cover our debt service. And uh, now a developer may come to us and say, "Hey, I'm a borrower may come to us and say, "Hey, I'm going to buy a property. It's distressed because this prime example. Blackstone just sold an industrial portfolio in Miami. I think it was a close to $800 million deal. We know that Blackstone is going to tell you that they made money off that transaction. That Blackstone made sold that transaction to a different group because they had high level of debt and that debt got paid off in full. Blackstone may have extracted all their capital out and equity out over time and refinances and such, and they probably got out clean. But ultimately, they sold that property because they didn't want to refinance $800 million worth of property. If somebody comes to me and says, "Hey, can you finance that?" We can, and we'll underwrite it at our new underwritten value. Great for us. I don't consider that a distress debt for us, but that might have been a distress sale. And I'm using that just as an example, just because I know that we're seeing a lot of transaction and turnover in commercial real estate space on good assets by some of the largest managers in the world, and it's all debt driven. It's not. It's totally not because they're taking capital off the table.
Ben, and I think you had also mentioned not only are they not taking capital off the table, they're actually investing more dollars into these projects from the sponsor. A lot of these tend to be, blue chip sponsors. They just got caught in a weird interest environment. So maybe you can talk a little bit about the cash in refis.
Yeah, yeah, exactly. We were just talking about that property in New York City. That's a cash in refi. That guy came to us. He was only the property was not distressed. He was at the end of a maturity default. He was going to end up in a maturity default, needed a refinance, and so he brought cash to the table. He basically righted the ship, per se, and that to me is not a distress. And that is actually, I will tell you that in 80% of our multifamilies, 85% of our multifamily refinances this year, they have all had cash into the deals. They were properties that somebody built for 60 million, and we made a $30 million loan, $30 million loan on it, but they had $40 million of construction debt. And so they had to bring $10 million to the table to keep that property. So uh, um, that's why Philip mentioned this. Some of our borrowers have to be well sophisticated borrowers with deep balance sheets, and um, they're able to do that. We're not looking for the new guy on the block that left that guy and said, "Hey, I saw all these distressed deals. I can do this. All I got to do is raise the money." That's fine. I hope you're successful, but that's the platform we're looking for is cash flowing properties at any so, at all stance, not distress.
That's a great answer. I saw the question to come in, and I'm thinking, wow, that's very specific, but you don't want to box in this the way you just presented that
Yeah,
into one category where people maybe get their own ideas. So well said and explained. Questions are done. A couple of things I just wanted to add. The vote came in pretty well. Maybe I shouldn't have posted it during this meeting saying, do you like live or recorded when people are attending live? Um, but we got, it looks like 7 votes came in and 57% were live and 43% depended on the topic. So The people who want to hear it recorded are probably not answering today because they're going to watch it recorded. So we'll see what your answer is later. I am going to post the same question onto the regular portal, and let's just find out through the rest of the members what they have to say. This is a great opportunity for me to pause and just sort of remind everyone the questions that you have. If you have additional questions and you're listening to this on the recording for Ben, the best way to do that is to go through Chris, and we'll make sure that you have Chris's information. It's on the portal already. We'll continue to share that information. But Chris, maybe just real quick, if you want to just share your phone number and email address, just so folks can have it on the recording as well.
Yeah, well, happy to. I believe it's on some of the marketing materials posted on the Advisor Network as well. Yeah, so my email is just my first initial C and then my last name, Mehalko, Mehalko, at infinityfunds.com. And then, yeah, I believe my direct contact info is there as well, my phone number.
Yeah, everything is online. You reach out to myself, to Alex, to Dave. We're going to connect you with Chris if you have any follow-up questions. One of the reasons that we're not specifically going to go into exactly how to invest in this is that one of the advantages of the Advisor Network is you all have different product offerings, different access points, different custodians, different firm rules, different levels of due diligence. What I'd like you to do is connect with Chris to look at your situation to see what the best vehicle would be if one exists, right? That's the good and the bad. You learn about a fund like this, maybe you want to go and request it at your firm if it's not already present. So there's not one way to do this. That's one of the roadblocks, one of the speed bumps with the Advisor Network is there's not one easy way to do anything. It's actually a culmination of a whole bunch of different firms and different processes. So Chris is your best point of contact for that. Obviously, Philip from the firm as well. And you heard his voice hop in there at the end and ask that last question. But if you have anything else, it looks like our questions are complete for today. On behalf of all of us, I'd like to thank the team at Infinity. Awesome first call for this. You guys did a great job. Really interesting space. I hope everybody who joined today or everyone who's going to listen on the recording takes the time, learn more, talk to Chris and the team, and educate yourself, if nothing else, and make sure you understand what alternatives are all about. So Chris, Philip, and Ben, thank you guys very, very much.
Thank you for
Yeah,
having us.
no, thank you so much for having us. We look forward to many more of these in the future.
Great. All right, everybody, if we don't talk to you and you're not on the next couple webinars, have a great holiday season. We hope to hear from you, though, before that. And thank you from the Advisor Network. Have a good day.
Thank you.